Okay, so this one, now we have the 1-2 work together. So in this one, we're going to be looking at how transactions affect the accounting equation. Or that accounting equation of assets equals liabilities plus owner's equity. And there's the accounting equation listed here at the top of our little chart with some boxes to fill in. So the value of the assets for a company is going to be equal to the value of liabilities plus the owner's equity in the business. So we have a list of transactions, just 4, and each transaction is going to affect 2 accounts. So we have our directions in the middle of the page here. So for each transaction, enter a plus sign in the appropriate column if the account classification asset, liability, or owner's equity is increased. Enter a minus sign in the appropriate column if there's a decrease. And there is a possibility of having both a plus and a minus sign in the same box. So let's look at transaction number 1. Bought supplies on account. So the business bought some supplies. Supplies is an asset. That's something of value that the business could sell if they decide they don't need those supplies anymore, or if the business goes out of business and has some stuff they need to sell off to raise money to pay bills, or some other scenarios that they need to offload the supplies and get some money back for them. So that's it. Supplies are an asset, so it's something of value. So bought supplies. So the business bought supplies, so that's an increase in an asset, so we'll put a plus sign there. They bought supplies on account, meaning the business is going to pay that bill at some other time in the future. So now that's become a liability, a bill that is owed, and we saw that in 1-1. Anything that's owed is called a liability. So now there's an increase in liability for buying those supplies, so we'll put a plus sign in liabilities. That gets us to transaction number 2. Received cash from owner as an investment. So the business received cash. So it's an increase in an asset. And due to that increase in cash, there's an increase in value of the business at that particular point in time. So that means that's going to be an increase to owner's equity, because anything of value that the business owns, the owner owns it by the fact that they own the business. Okay, number 3, paid cash for insurance. So the business pays cash, so cash is going to be going out, like a checking account. So they paid cash, so a minus sign for that. Now the insurance. Insurance is an asset, because if that insurance gets canceled, and whatever value is left on the insurance can be refunded back to the business or the business owner, that cash is an asset that comes back into the business, so we'll consider insurance as an increase in an asset. So a plus sign in the asset box. So now I've got that minus sign and the plus sign under assets. And the last one, paid cash on account. So we paid cash, so minus sign. Oops. Paid it on account, so that was paid it towards a liability. So now the amount of money that's owed is going to decrease. So we have a decrease in the liability, so a minus sign under liabilities. And then we'll get into some more of this in 1-3 when we actually have some separate accounts to look at. But there's the 1-2 work together.